Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 20th of October, 2022. We got a friend of mine, an ex-colleague coming on, and one of the best research in the business coming up right now. Austin Root from Stansberry Asset Management is about to join us here on Making Money. Again, welcome to Making Money. This is Matt McCall. Thanks for joining me. It is the 20th of October, 2022. Beautiful day outside. And again, a friend, an ex-colleague of mine, a guy that's been around the business as long as me. And I got to tell you, just an all-around great guy. Austin Root. He's a chief investment officer at Stansberry Asset Management. He used to be the director of research at Stansberry, where I work now. So we got a lot of overlays, a lot of ties, and we're going to dive into the market. What we're looking at, we're looking at two different things, believe it or not, but we're on the same page. We're going to talk about sentiment. We're going to talk about what sectors he had coming into the year and what sectors he's looking at now and what catalyst will be that catalyst to tell him to put more money in the market. Without further ado, here he is, the man, the myth, the legend, Austin Root, Chief Investment Officer at Stansberry Asset Management. Thanks so much for joining the show, Austin. Great to see you, buddy.
Thank you, Matt. Thanks for that kind intro.
Sure. So let's jump right into this market right now. I mean, we've had a wild year, a wild month of October, and October is often referred to as the month of crashes, but also the month of bottoms. And I think we could see maybe both of them potentially in the next couple of weeks in this market. And you look at the sentiment of the individual investors, which you speak to every day. I mean, some of the numbers are just absolutely mind-blowing, from the AAII survey to the amount of puts that were bought last week by individual investors, showing the fear and the hedging that they're looking to do. What sense are you getting from your clients and from your investment team right now on really where the sentiment is, where this could take us?
Yeah, thanks, Matt. I mean, it is amazing. The AAII investor sentiment that you noted is as bearish essentially as it's ever been. So that's more bearish than the dot-com bust. That's more bearish than when we were in the depths of the COVID before we had the vaccine and people were worried. It was more bearish than 2008, 2009 global financial crisis that we both remember, which is surprising to me because I'll tell you personally, I am less concerned about the overall health of the market and the overall health of our economy and liquidity and our businesses than I was in any of those three times. What we see are individual investors that are concerned. Our investor relative to the average investor is informed. Our clients are very informed, but there's a double-edged sword with that, right? They're reading a lot, they're hearing a lot from some of your colleagues and other folks that are also very, very bearish. And so that's a concerning thing for them. There are lots of things to be worried about, Matt, and we should probably talk about those things. But for every one of those concerns, you could also argue, well, gosh, it's already in the market. And if we just go from a period of bad to less bad, gosh, that's generally very, very positive for the market. The last thing I'll say on investor sentiment is, unfortunately, it's been a really good contra indicator, which is to say, when the vast majority of people get bearish, that's the time to get greedy.
Yeah, I mean, I've historically been a contrarian investor and like to go against the masses because history tells us, not just the last few decades, but going back with financial markets overseas for literally centuries that if you take the opposite end of the masses, you typically do pretty well over time. I mean, it
That's
doesn't
right.
pick the bottom. And I think that's what people have to realize. Just because these numbers are flashing, it doesn't mean now is the bottom. It means we're likely in a sweet spot. Because you mentioned those other pullbacks we had, 08, 09, COVID, 2000. We've had really high levels of negativity in investor sentiment then, not as high as we're seeing now for a lot of readings, but it didn't pick the bottom, but it was within a few months. So, I
That's
mean,
a great
and
point.
again, I'm assuming your investors are long-term investors. So you get that sweet spot. Boy, it's tough to kind of turn down some of these stocks. They're down 70%.
I totally agree. And so two things on what you said. One, to your point, when markets get oversold as they have recently, that isn't necessarily the bottom, because when we've seen the bottom, it's been that they've got even more oversold. So you can, to your point, it doesn't necessarily mean that we're there. The other piece is, let's not heap this all on individual investors. Institutional investors are also very bearish. You mentioned some of the put buying data, but also the amount of cash on the sidelines within institutional investors is higher than average, and they don't have a perfect track record either for figuring out when that is.
So you were in the institutional side for quite some time. So let me ask you this. When I think about large cash positions, and very wealthy people are paying these institutions to make them money, not to sit on cash. I mean, they're protecting, but not to sit on cash. So when you start to see the market come back and some of that money comes off the sidelines, correct me if I'm wrong, won't you see a lot of money come off because you're kind of going against your peers a lot of times? And okay, the guy across the street, he's buying big lots going in the market. Maybe I should buy some, and kind of buying begets buying. You see that happening at some point?
I think that's right. I think if we see a little bit of a rally, which we can talk about, midterm elections for the last 80 years, the year after a midterm election has always been positive. And so that's not to say that it's foolproof, but if we see that trend again and we see the market build here in November, you'll definitely see some institutional investors coming in and making sure that when those year-end statements are shown to their investors, that, gosh, they own some of those stocks that are doing well.
Yeah,
I do think this is another thing that you'll see is you do not want to give your taxable investors a realized gain in a year like this. So when they're buying some of those winners, you could see some of the losers take a little bit of a short-term hit because they do not want to show a realized gain in a tough market for literally almost every asset class. And I think just to touch on the first thing you mentioned, why are people so worried, and why are even institutional investors worried? Well, it's because nothing's worked, right? Virtually nothing's worked. And so some of those things that are the worst off, you could see a little bit of a weakness there just by people trying to do this shift that you're talking about.
Yeah, and that makes sense. Sell those losers, tax harvesting there, takes those losses, offset any winners that you may have. But you bring up a really good point where historically there's always somewhere to hide, during times like this. Mm-hmm. And as you know, the 60-40 portfolio, 60 equity, 40 fixed income, is really going to go down in history as one of the worst years ever. I mean, ever. And I think that's why this feels different. And I think that's why the sentiment is so negative, because the people that had high exposure to bond ETFs and bond funds, they're getting absolutely demolished this year, demolished. So when you have that on top of the stocks going down, all the crazy stuff going on in the world, you can't really blame them for being a bit negative. But you talked about your investors are educated. A lot of them read a lot. When I had my firm, same thing. So they actually, a lot of times, it became a little bit dangerous because they did read so much. I feel that majority of the people in our business are probably negative as well right now. Some of them, like myself, I think there's a great opportunity right here. Do you feel like investors aren't as much negative, but the people that you talk to, are they kind of like deer in headlights because they're kind of getting conflicting reports of what to do? They may see opportunity, but at the same time, they see their portfolio keep going down. And I feel like that's a really strange place to be.
Yeah, Matt, I totally agree with both of those things you said. On the second one, just in terms of deer in the headlights, Look, Stansberry Research has some really great editors and market analysts. But to your point, you even within your firm, you have folks on both sides of this that are saying, this is, there's a lot further to drop in this market. And then other people are saying, okay, look, actually, let's put our long-term growth hat on, and this could be a great decade. And now's the time to be buying stocks. So that's a huge challenge for folks. I'm getting mixed messages from folks. I will say though, I think more of the messages, to your point, right now are bearish. And if we just think about the investment research, investment newsletter, and even mainstream media as a business, what sells? Well, generally either greed or fear. No one is greedy right now. So a lot of people are pushing those fear messages. So I just think people are getting more of that than they would in a normal environment.
So what are you doing for your clients that are calling you with that fear in their voice? I mean, I was there for 17 years. Those aren't fun calls a lot of times. So what are you guys doing over there at SAM to kind of hedge the portfolios, if anything?
Yeah, that's right. So maybe taking a step back and just saying what we can really help folks with. So having great investments is like having great ingredients when you're going to fix a meal. It's mission critical. It's the table stakes, but it's not the only thing that you need. And so the first thing we do with our clients is really make sure, first and foremost, that we've isolated and figured out some important things for investing. What are your investment goals? Are you looking to build wealth and grow your wealth over time, and therefore, or are you looking to protect what you have? Are you looking to generate current income? That's kind of the first thing. Second, what's your time horizon? So the longer we can go out and think about this, the more we can invest in things that should outperform over the long term, like some of the stocks that you and I like. Then next thing, what's your risk tolerance? So look, if you can't sleep well at night owning some of those things, let's just be a little more prudent. And we have a capital preservation strategy that's materially outperforming the market and materially outperforming the 60-40 because of the ways we've put it together. So that's the first thing. Then on top of that, our clients really want to know that we know what we own and why. I think there's many investment managers that are just focused on gathering assets. And then once they gather the assets, they do a good job with their clients of saying, okay, let's think about how we allocate these assets. And have we thought about some of the sort of financial planning aspects of your life? But they have no idea what their clients own. And if we were the client, Matt, you and I, we would not want a financial advisor that had no idea what I was invested in, let alone why. So that's the in terms of calming folks. The first piece is know your goals, your duration, your risk tolerance. Then it's know that we know what we're own, and we want to have conversations about that. Great. I think the other piece, if I could toot our own horn a little bit, Matt, is we've done pretty well this year on a relative basis. It's been a tough period to make any money, but we're losing considerably less money than the market, and that's because we're doing some things that I don't know. We have some specific strategies that I can, if you want it, I can talk about a little bit.
Is there certain asset classes though that you're looking at? Because again, there's not a lot of places to hide. Obviously, energy stocks have done very well. Some natural resources have, but there hasn't been many sectors that can even outperform.
That's true. So we came into the year overweight energy and defense, and those things have done well for us. We remain overweight those. We thought that geopolitical risk looking across, not only do we like things like Lockheed Martin and that they were attractive relative to their long-term earnings power growth, but we just thought the world was a little bit, and this was pre-Russia, Ukraine. So in fairness, maybe we got a little lucky there. But those are two pieces. We didn't own a single bond across any of our strategies coming into the year because when interest rates are going up And when your concerns about default rates are going up, that's not the time to be owning bonds. So that's really benefited us. We have switched that though. So some of the cash we've owned a lot, we've had a lot of dry powder kind of on the sidelines. Some of that dry powder, we have a decent amount. We've moved from cash to short-term U.S. Treasuries. I mean, if you can generate 4%, that's in a short-term way where you're not taking duration risk, and I believe you're not taking credit risk in the short term, then that's a good way to invest. The last piece, Matt, is in addition to owning just great businesses that you and I can talk about, we have found one spot in particular that's not correlated with the market, and it's actually become more attractive to us over the year, and that's merger arbitrage. So that is where we're looking at a business that the risk of us making money is whether the deal happens or not. It's not whether the market goes up or down. So I'll give you an example. It's one that if your listeners are part of Stansberry Portfolio Solutions, they've recommended this stock. I won't tell where in case they're not, but Activision is being acquired for cash by Microsoft. That deal may or may not close, but the deal is being done at $95 a share in cash. The stock, Activision stock, is trading in the 70s now, and so on a daily basis, that spread from the 75 to 95, which is what we're looking to collect over the next year, will go up or down based not on how the market's doing, but based more so on people's views of whether that deal will close or not. So that's an example of something where it's uncorrelated to the rest of the market. And if we can fill our portfolio with some of those things in a world that everything is correlated, we can outperform over the long term.
That's great. Yeah, that is a lot of these deals. I own some Twitter, my personal account, and I had to watch it go down, thinking the deal wasn't going to happen. And I thought, well, he said a lot of things they're going to force him to do it, and they would have forced him to do it, in my opinion. And he finally said he's going to do it, and still it trades below where the deal price at this point. But I think that's a great strategy to take there. And I just saw something I was trying to find out while you were talking this morning, Austin, that was showing the correlation between equities and fixed income at the highest level in decades. And obviously that has to do a lot with 60-40 getting hit. And typically during a recession, bear market, interest rates are going down, bonds are going up, and the exact opposite is happening now. So it's a bit of an unprecedented area. So let me ask you this: when you speak to a client, whether it's via email or something, or via on the phone, and their main concern is, listen, even if they're considered one of the more aggressive portfolios, they're concerned just about losing more money. How the hell do you convince them to say, listen, okay, not only are we going to hold these positions, but we do see some great opportunities here to buy now? How do you get that across? Because I think there's a lot of people out there watching right now that would like to hear that message.
Yeah. So great question. First thing is we eat our own cooking at Stansberry Asset Management. So I think that's helpful to know. My largest investment in our strategies is within our venture growth, which is that sort of long-term capital appreciation focus. It's sitting right beside our clients, paying full fees, and I've added to it as it's gone down. That's the first piece. The second piece is, again, we just sort of reoriented folks and remind them from the day one we talked about this, is that there's no free lunch. If you want those long-term world-class high returns, you have to be able to stomach higher volatility at times. And so we've endured that, and now's not the time to then sell. To your point before, it's the time, if you have the capacity and the duration and the stomach, to be adding to things like that. And so we'll talk about some of the things that we're seeing. Actually, that was my question to you. You look at a lot of trends, you look at a lot of secular trends and innovation. Is there one, and do you have a favorite? I'll say one, just to give you a second to think about what might be your favorite. Unfortunately, growth in cloud and growth in cybersecurity. Really, the unfortunate part is the cybersecurity issue. That's a growth business for the foreseeable future. And so, we own some businesses that are cloud-based that are more about network monitoring, network observability, and because they touch every point of a company's computing function, they are now morphing themselves or expanding into security because it's just an important, you need to be able to see everything on a real-time basis. And so that's an area that as other parts of technology may have seen a slowdown, we're not seeing any slowdown there. And so that's a transcendent growth area that we really, really like. And unfortunately is a growth area.
It is. And no, I first of all, I want to touch on cybersecurity because oftentimes, that was a hot topic to me 10 years ago, when that was kind of just like starting to big companies get hit with hacks. But the thing is, if you look at the statistics, and I'm a numbers guy, I mean, it goes from lower left to upper right, the amount of cyber attacks that governments and companies deal with every single day that we don't hear about, that they're thwarting by using these companies' great software. So yeah, I mean, this is somewhere, it's not sexy anymore. It's kind of, but it's an area within software that, like you said, this is not stopping. The next World War III could be fought through cyber for all we know. I mean, so I think that's a great area. I'll give you one area that's kind of outside the realm of what I normally do, and that's nuclear energy. I think there's no way that we're going to even come close to meeting any of these net carbon goals that we have as countries, and even individual companies in areas, because it's just not going to happen. I believe in solar. I believe in wind. I just read this week that they're going to start auctioning off offshore wind off the coast of California to companies that build big wind farms out there. And that's going to continue. The problem is, it's just we don't have the grid for it yet, where nuclear energy is it's clean. It's completely clean. And you eliminate Chernobyl, which was that's a whole asterisk mess on its own. Fukushima shouldn't have been built there. And 3 Mile Island, nobody ever got sick from it. So let's be real here. There hasn't been really many accidents. Look at how many accidents there's been in oil and gas over the years. I mean, there's been a lot of accidents there. So I think there's huge opportunity. And what's going on in Ukraine and Russia makes people really realize they have to not rely on certain countries and areas of the world, and they have to start doing it. And then you have what's called SMR, small modular reactors, which can then power industrial parks, little areas, remote areas, much safer. You have Bill Gates backing it, other billionaires backing it.
That's exactly what I was going to say. Yeah, that's exactly what I was going to say. My father-in-law worked on developing these large-scale nuclear power plants, and then the issue with is not the operational cost. Those are actually very cheap, but it's the construction cost. They have to over-engineer those things because of the Chernobyls of the world. If you can get these small-scale reactors to work and work safely, golly, it's really an efficient way to generate power.
Yeah, and it's one of those things too where try to think what can be uncorrelated. That could be something that's uncorrelated to the rest of your portfolio. It should be over time. In the near term, it's considered risk on, and so you're going to see it sell off. But that's one area that I think would do well. So obviously we'll talk a lot more at the conference. But before I let you go, I always ask every guest, you don't have to answer it, but if I send you and your family and whatever guests you want to take with you to your island of choice for 10 years, but you can't take any electronics with you, and you have one investment or one sector that you want to buy or one asset class to buy, is there one that you like, Austin, for next 10 years that you're okay putting under the mattress and walking away?
One sector, investment, or asset class?
Yeah, anything. It could be anything.
Yeah, let's see. I mean, my gut is the cybersecurity, but I want to try to come up with something different since I just said that. I would say.
I hope you're taking so much time because you have so many ideas that you just
so
many
we have
ones I don't know what to do.
Yeah. We have a lot. I'll say one that you probably haven't heard ever, but I'll tell you, it's amazing to look at the long-term stats on it. And this is the RV industry. It's a cyclical industry in terms of any one year, but every decade for the last 7 decades, there's been more RVs on the road than the previous decade. And so
Wow.
I just, I had a conversation with Porter Stansberry last week, and he wants us to invest more capital for him. And he's like, look, all I want to do is buy businesses that I'm sure will be bigger, better businesses a decade from now than they are today. And that's one of them. So not necessarily the equipment manufacturers, but those businesses, Camping World is one of them, that can benefit from the ecosystem growing. If we're all, spending more time outdoors, believe it or not, you and I are on the coasts, but the middle of this country absolutely loves RVing. And again, it is a growth industry because just look at the data. Every decade, more people across the country and the world are RVing. So I'll invest in a winner like Camping World that generates an incredible return on investment. In that business, like basically becoming the AutoNation or the CarMax of the RV world, because these are all mom and pops that they're competing against.
Yeah, and I lived in Nashville for about 2 years a little while ago, and dated somebody in Kentucky, so we drive up whatever that was, that highway, can't remember the name of it, but you go up there and there's Camping World. I mean, and this thing was an amazing just display of RVs, and these aren't RVs like a lot of people think, cheap RVs. These are extremely expensive vehicles and beautiful inside. I mean, they're amazing.
Beautiful. Yeah, 45 feet, and then they have these things that slide out, called slide outs.
Yeah.
So like the amount of square footage you can get in one of these things once everything's slid out, and I mean they're homes. They're medium-sized homes once you get to it.
Nothing like having your home on wheels. I mean, I would actually like to do that. I'm a city guy. Part of me would love to drive around the country for 6 months and just see the world, or see the country, I should say, in an RV. That's a great idea. I love that. Thank you so much. But thanks so much for being on. And again, I'll see you next week in Boston live. I can't wait to hear your ideas. I always love listening to you, and your team will be up there. So I'm sure we'll get together and talk up there. So if anybody wants to meet Austin and his team in person, obviously, that's a great way to do this. And if they want more information, what's the best way to reach out to you?
That's great. Yeah. So stansberryam.com is our website, and you can learn a lot of information about us on that. If you want to send us an email, you can send us at info@stansberryam.com. But again, that website has a lot of stuff. We have some videos. You can find us on LinkedIn and YouTube, but I'd say start with the website.
And I guess we could say this, it's all public information. I sold Penn Financial Group, my firm, to Austin and Stansberry Asset Management. So that's how much I believe in them as well. So yes, I think if you, and Austin, people ask me all the time, Matt, can you run my money? I'm like, I don't do that anymore. Who can you recommend? Obviously, I always recommend your shop, but you think about it, there's not a lot of great financial advisors out there. Because as you mentioned earlier, for a second there, most are just selling. They don't know why they own what they own. They're just trying to get assets under management.
Yeah, I totally agree.
It gives us a bad name.
It's crazy how the financial services industry has bifurcated. There's the T. Rowe Prices that are the stock pickers, but they don't have any relationship with the end client. And then there's, not to disparage any asset manager or investment manager, but there's these wealth managers that are just using someone else's funds. Mm-hmm. It sounds novel, but you, Matt, and us at SAM, we're trying to do both. We're, because like we said before, our clients want to know what they own and why. They want us to know what they own and why, and build a portfolio around that.
Yeah. Well, keep up the good work, you and your team. Obviously, I just met your new CEO. I had lunch with him 2 weeks ago. And I'll tell you, awesome. I back him 100%. He was a great guy. So I'm happy to see that. But keep up the good work. And again, if anybody wants more information, please go to stansberryam.com. And again, a lot of great information there. You can reach them through them. And then somebody in Austin's team will reach out to you.
Awesome, Matt. Thanks so much. It's been a pleasure, and look forward to seeing you in Boston.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.